following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Greg Manel sitting in for Kim Parley. Markets are off to a strong start this year. The S&P 500 enjoying its best January since 2019. But of course, there are still concerns, including rising interest rates and a potential economic downturn. For some insight, we're joined now by David Sykes, Chief Investment Officer at TD Asset Management. David, great to have you here.
Thanks, Greg. Great to be here.
All right, so if we're talking about rates, and we've been talking about rates for a long time, let's start with the big one, the big story of the day, the big story of the week. The Fed coming out, hiking once again by a quarter point, saying more work needs to be done. How should we read what we heard from them?
Yeah, interesting day and an interesting market reaction. So the facts first, the Fed has raised 25 basis points. That's a shift down from last time where they went 50. I think, to put it in perspective, they've moved 4.5% in the last year or so. So pretty aggressive movement. I think the statement was interesting because it told the market further hikes may be necessary or as appropriate, I believe the language was. But in the press conference, it was quite an interesting statement. Chair Powell said, we're happy to see disinflation. And so I think that really got the equity market jump-started. But I think it's fair to say we're closer to the end, for sure, in terms of Fed rate hikes.
I mean, that's definitely what the investment community has been waiting for, right? The amount of pain that we saw last year because of these aggressive rate hikes, just like, well, at least let's see something for the effort. I mean, are we winning the battle? The word disinflation seemed to suggest that the central banks, and maybe include our own, feel that they are winning the battle, or at least moving the battle in the right direction.
Yeah, I think that's right. And I think it's also very fair to say that with today's release in the press conference, I think it very, very much met expectations of the market. I think the market was looking for 25. It got 25. We'll see a reaction in a day. You never know. But I think they've done a lot of work. There's probably a bit more to do. But as I mentioned, we're probably, one or two hikes away from the pause or the end.
What I found interesting about what the Fed has been telling us and what the bond market perhaps has been reading into it, there seems to be a disconnect, right? I mean, I can understand the tough talk from central bankers saying this is a fight and we're still in the fight. But the markets seem to say, well, the fight's not going to take as long as you think. Are we going to come to some agreement between the Fed and the markets, or are we going to see this sort of play out for a while?
I think you're going to see it play out for a while, and it's really going to be data dependent. I mean, the Fed in the press conference today, Chair Powell again said, look, he doesn't have all the answers, I'm paraphrasing, but we're going to look at the data, see what's coming. But I think you highlight a big discrepancy, which is the market is thinking two hikes in the back half of this year. The Fed is clearly saying, no, we're not going to do that.
Or two cuts, right?
Sorry, two cuts in the back half of this year. And so the market is saying, yep, we're going to see some easing. I think the Fed, for the reasons you highlight, they're not going to come out saying we're very strong against inflation. Oh, by the way, we think we're going to ease conditions in the back half. So, we'll see what happens here. But I think it's really about the data. And we have seen inflation numbers start to, in general, tick down.
Okay, so let's talk about the start of the year. It was a pretty strong January, the best for the S&P 500, apparently since 2019. Obviously, there are still concerns out there, and perhaps the central bank has some of the concerns as well. What should we be thinking on that front?
Yeah, so very strong start to the year. I think if I think about growth, though, globally, if I look at Canada, the United States, we've had relatively weak GDP numbers. The consumer's hanging in, but investment, housing has been an area of weakness. We've had a big inventory build in the U.S. that's probably not going to continue. Globally, if we look at Europe, PMIs have been slow. There's a reopening in China, which is a positive, but net, I think we're seeing slowing growth. And the real question on the market's mind is this mild recession or is this a hard landing?
Yeah, the outlook on growth. I mean, the IMF got a little more constructive this week, but it still seems to be a moving target, maybe on a daily basis. When I try to figure out what people are saying in terms of a chance of a recession, it seems to change on us every day.
Yeah, it literally does. And I think it's very much dependent upon, how many more hikes and how long do we stay at a certain level. And I think that's really going to be incumbent upon the inflation data. We've seen it come down. It was 9.1% in the U.S. We're down to 6.1 on the headline. Core numbers are a little bit lower. I think the next few months are really going to tell us, because of the base effect, what's happening. And I do think you're seeing that general trend downward. But, the jury is still out. There's some issues in the services sector where wages and salaries are continuing to remain high. You see goods prices coming down, transport costs have come way down. But there's still this overarching doubt, I think, in some investors' mind. Have we really solved inflation, getting it back down to that 2% target?
I think Chair Powell keyed in on that today as well. We're watching this part. Clearly housing and other areas have, softened, but we're watching the services. So if that becomes sticky and that becomes harder to work on, does that mean that perhaps we start to believe the Fed more than the bond market in terms that we're going to get rates to a certain point and we're going to leave them there for a while and they're here to stay?
Yeah, and I think that's really that would be different than expectations of the market. And I think that is the risk here. I think, I'm not sure it's the base case, but I think for us, the risk is you're seeing wages and salaries being sticky. And, I think the expectation, as you point out, the market expects a cut. What if we look at some numbers? You look at job openings in the United States as an example. There are 11 million job openings that came out in data this morning. In the labor force, there's something like 6 million Americans looking for work. That ratio is usually 1 to 1. Right now, we're at about 1.8, 1.9. So you've got a lot of people who are looking for work, but there's almost 2 jobs available for every person who's unemployed. That's going to give some power to labor. That may mean that wages and salaries are a little bit stickier and last a little bit longer. And I think if that scenario plays out, that's the big risk to the market. Rates a little bit higher than we expect for a lot longer than we expect. I don't think that would portend very well for corporate earnings and for valuations in the market.
Let's talk a bit about that because, of course, the central banks are grabbing all the headlines in recent days, but we're in the thick of earnings season. What is the impact here or the possible impact on earnings?
Yeah, so one of the things we have to make sure we understand is that there was a lot of hiking last year by central banks, Fed, Bank of Canada, all around the world. It takes time. There's a lag effect here. We haven't really seen the teeth of those hikes kick in yet. But I think it's fair to say in the fourth quarter in the U.S. earnings cycle, you're starting to see some of that. Revenues are holding up. We're expecting about 4% revenue growth year over year. Earnings growth was actually negative 2% expectations. We're doing a little bit better. We're probably flat to down slightly year over year on earnings. But the concern we have is on the margin side. You're starting to see margins compress. And I would also say in terms of forward guidance, there aren't a lot of companies who are saying, yep, it's going to be a great year and we're taking up our numbers. We really feel strongly that 2023 is going to be a fantastic year for corporate earnings. So I think from our perspective, we still think there's some downward revisions to come in those numbers. And of course, ultimately, equity markets are driven by earnings and the growth rate of those earnings. And I think we haven't seen the full extent of those downward revisions yet.
And that gets me thinking about valuations. I mean, what you're willing to pay for those earnings. Are they being sort of fairly reflected in the state of the market right now?
Yeah, I think for us, they're a little bit on the high side. If we looked at earnings expectations for 2023, it was $250 plus or minus about a year ago. It's been ratcheted down now to about $230. That's going to give you a multiple on the market of about 18 times. That compares historically to something like 15 to 16 times. So you could say we're a couple of turns on the earnings, a bit expensive. But I think a better way to look at it is relative to a risk-free rate. And all of a sudden, with this backup in yields, bonds are competitive now. And so if we looked at the inverse of that PE multiple, let's look at the earnings yield, it's about 5.5%. That sounds attractive, but when you compare it into a 10-year U.S. Treasury that's 3.5, you're only getting 200 basis points of equity risk premium to dip your toe into equity. So from our perspective, I think on that basis, valuation's a bit rich as well.
Fascinating stuff. When we come back, David Sykes is going to tell us TDAM's investment strategy for 2023 and what he thinks is the most important thing for investors to consider this year.